Welcome, everyone, and thank you for joining us this evening for Flagship Financial's halftime report. We look forward to providing you with a lot of great insight this evening. Um, and this is one of these fun events that we really enjoy doing every 6 months, just to be in contact with each and every one of you to provide you with an update on economic policy, political environment, um, the investment direction that we believe we are heading. And tonight, we are honored to be partnering with a great group out of Philadelphia, a hometown player named Clark Capital. And as everyone on the call here this evening knows, we partner with a number of different asset managers in the industry, and we've had a great partnership with Clark since inception. They've done a great job. We really appreciate their commitment to our team. We appreciate their commitment to our clients, and we appreciate the great job that they've done at partnering with a number of our clients to help them achieve their long term. I keep getting muted. I'm not sure why that happened, but um, without further ado, I want to welcome Mark Manos and team to help provide us with some insight this evening. Mark and I have a long-standing relationship. Mark is a senior investment consultant with Clark. Um, he's been with the team for over a decade now, and prior to him joining Clark, he was with Lincoln Financial Services for a number of years as well. Has extensive background in financial services and is just a great guy to partner with and make sure that we're providing great diversification and asset allocation for all of our clients. So his team is here with us tonight, and I'm going to let him do the introduction to each one of them so I don't steal their thunder. But I would like to ask everyone to stay muted. There will be time for Q&A at the end, but just so we don't interrupt the flow of the presentation, please feel free to use the chat feature. I see a number of individuals have already been using it as we are doing the introduction here. So if you are not able to locate it, it should be in the upper toolbar. There's a little bubble. It says chat. Please feel free to type in any questions you might have. This is going to be pretty interactive. I know we have about a 30-minute presentation, but we're hoping that each and every one of you can take some information from that presentation and get ready for some Q&A at the end. And again, without further ado, I'm going to turn this over to Mark and team. And just sincerely from the bottom of my heart, I want to thank Clark again for being a part of this evening.
Absolutely. Dean, thank you so much for that introduction, and thank you for the opportunity and partnership. And folks on the line, hope everybody is having a wonderful summer. Hopefully everybody is just as excited that Philadelphia Eagles training camp has just kicked off and football season is around the corner. But again, by way of introduction, folks, my name is Mark Manos. I am a senior investment consultant with Clark Capital Management Group. So I'm not a sales director. I'm not a marketing director. I am an investment consultant. And that's exactly how we at Clark Capital partner with elite independent financial advisors like Dean and his team at Flagship. It's really in that consultative capacity to find the right solutions for specific client situations to put you folks in that place to be successful. So we really work in a mentality that looks at your overall financial plan and find the right solutions that fit within that plan. This evening, joining me, I have my relationship manager and internal business partner, Joe Coopersmith, who's just an extension of my team, as well as our client portfolio manager, Ryan Gardner. Ryan has a foundation in the investment management industry that spans nearly 2 decades, where he has helped with portfolio construction, capital market, and economic outlook. And one of the great things that Ryan has the ability to do is work directly with our financial advisor partners and end investors to really get the insight and questions that they have that may be driving some of their financial decision and investment decision making. So Ryan has the unique ability of actually sitting directly in between our equity and fixed income management teams, the folks who are actually making the investment decisions and pulling the levers behind the scenes, and taking all of this complex data, information, and detail and really breaking it down into simple, digestible language that we can utilize with our financial partners and end investors to keep you folks informed and educated on not just who we are and what we do, but more importantly, why we are doing things on your behalf. So, with that, I would like to hand it over to Ryan for his prepared comments. And Ryan, the floor is yours.
Great. Thank you, Mark, and good evening to everyone. Thank you for attending. As Mark mentioned, as part of the client portfolio management team, our mission is to partner with elite financial advisors such as Dean and his team. We want to provide you with industry-leading service and really asset management excellence, as Mark explained. We truly do value these webinars. It allows us the opportunity to spend time with you on capital markets, the economy, provide you with our investment outlook, and ultimately so that you can stay on track to achieve your long-term financial goals. So starting first with how we view things at Clark Capital at a high level. Our founder, Harry Clark, he is a boating and sailing enthusiast, and he thought it'd be best to actually position the economic gauges in terms of the very high level how we view this. So starting first with the middle point is neutral, so 12 o'clock would be that allocation at neutral. And anytime you see a gauge to the right, that would be a positive or a tailwind for stocks. And anytime a gauge is to the left, think of that as negative or headwinds for stocks. So 4 out of the 5 gauges are neutral. So what this does not show you is the direction of travel. So monetary policy and interest rates actually were one to the left 2 quarters ago, and we actually upgraded those to the right. I'm sure most of you on the call, looking at your stocks and the bonds in your portfolio, you've noticed the tailwinds pretty much since the October lows of last year. It's been a pretty good run for both stocks and bonds since that time. I'm going to go through this in some detail in terms of how we actually make this decision, but just in terms of a high-level summary, I want to just highlight that we actually updated our price target for the S&P 500. Sean Clark, our Chief Investment Officer, raised it from 5,300 to 5,800. He did that actually beginning of the month. And primarily why we've upgraded our price target, just to have context, it's roughly 5,400 as we speak, is there's a lot of earnings growth. We've seen tremendous earnings growth. I'm going to go through that. I will go through the election. It's very much at the end of the presentation, so we've got some good information and insight into the election towards the end of the year. But looking at performance and the journey we've been upon since the start of the year, this is looking at the major indexes since the beginning of January, all the way up until the end of June. So it's been a continuation of that 2023 theme, the large cap growth technology names. They've continued to drive performance. Some of you may have noticed we had a good inflation number on July 11th. So that's really started during the month of July, a pretty large rotation away from some of those winners, some of those large cap technology names towards the mid and small cap. So we've seen the Russell 2000, which is the blue line on your screen, which was below 2% at the end of June, is actually north of 10% as we speak today. So that gap between the smaller companies and the large growth has really narrowed. To give some context in terms of what I'm referencing, if you think of the NASDAQ, that's a good proxy for technology stocks. And then the Russell 2000, as I mentioned, is small caps. It was the biggest 5-day outperformance we experienced in the month of July of Russell 2000 versus the NASDAQ. So it's actually the best we've seen since 1979, basically when the index began. That's how impressive this rotation has been in recent weeks. We are going through some market volatility and turbulence. I thought it'd be useful to frame a typical setting for volatility. This is data since 1928 for the S&P 500, and it shows the frequency of market declines. If we think back to the lows of October 2022, so not even last year, the year before that, it's gone according to this general script. We've had 3 5% corrections or pullbacks, and one 10% correction since that time. If anything, in professional investments, we believe it's healthy to have declines. Certainly from my perspective, it removes excessive exuberance in the market, a lot of optimism. We see speculators, people who trade very short term, they think it's easy to make capital gains. So as soon as we get some volatility, it really removes some of that optimism, because some traders, again, I'm not referencing investors, the traders do get into a false sense of complacency. They get into this sort of lull, and they start thinking it's easy. But it's been a good start to the year. The S&P 500 is still up over 15%, even with some of this recent volatility. Today is a great day to talk about the economy. Some of you may have seen at 8:30 this morning, it was the second quarter GDP growth, so gross domestic product, which is how we measure the size of the American economy. So it grew by 2.8. That's adjusted for inflation. So you actually have to add back inflation to get that measure of the economic growth. So it was a good number. Generally, the market was looking at about 2%, so it was a little higher than expected. And when we look at the economy, one of the biggest things that's been driving it has been the labor market. Some of you may have read or listened to our 2023, or even this year, our 2024 annual outlook. And we said that until there's meaningful weakness in the labor market, calls for recession do seem premature. So we're not seeing any signs of recession. There has been a lot of strength in the labor market. So this is showing on screen the level of unemployment in the US. So that number is actually a little higher. It's 4.1% today. Last year, we got to a low of 3.4, actually was in April. So the labor market, think of employment, it was red hot. People getting large increases. We saw wage growth. And coming out the pandemic, there was almost 12 million vacancies in America, and there were only about 6 million people looking for work. So it was a 2-to-1 ratio. So hence why it was a red hot labor market. That started cooling. It's still a good labor market, but as it says on the slide, it is normalizing, which is once again a good sign, seeing it back to the levels. We did have 27 months in a row of unemployment being below 4%. And if you see versus the chart here going back since 1948, the last time America had these low levels of unemployment was the late 60s, before we went into the 70s. The sort of orange dot you'll see on screen is whenever the unemployment has ticked 0.6% higher than that low, that has been a recessionary signal. So the shaded areas are every time that America has gone through a recession. So this is why you'll start seeing a lot of commentary talking about interest rate cuts to help stimulate the economy from this point forward. And then tomorrow, we're going to get an update on inflation. The Fed's preferred measure is something called PCE, personal consumption expenditure. That's the green line you'll see on this chart. Classic finance or capital markets, we can agree to one measure of inflation. So we have three. So what all of us on the call, what we actually will pay is the blue line, that's consumers. And then the red is producers, so think businesses, think wholesale. So you can see the general trend coming out of 2022 has been inflation is moderating. It was a little bumpy the start of this year. You can see it wasn't as smooth in the path down as what we would have preferred, but it certainly is continuing that trend. And then 8:30 tomorrow morning, we're going to get another insight into that inflation, and specifically for the Fed in terms of how they set interest rates. Just a nuance I want to mention for inflation. So when you see economists or capital markets reference inflation, it is the rate of change. It's not the actual price level. So a simple example, think of the price of milk. Let's say it's $4 a gallon. If it goes from $4 to $5, so that additional one, that would be a 25% increase in the price of milk. So call that 25% inflation. If that milk then the next year goes from 5 to 5.25, that would then be a 5% increase in inflation. So technically inflation has slowed down from a pace of 25 down towards 5. But what you will notice is that the price is certainly higher than what it was before. So think about groceries. They're certainly much higher today than what they were 3 to 4 years ago. But the rate of that increase is slowing, and that's what capital markets take a lot of confidence in. The Federal Reserve's mandate is to have a long-term target of 2% in America, not 0, it's 2, and that's what we're trying to achieve. So we don't actually want prices going negative. I've had comments from some of our high net worth clients saying they would like to see prices go back to where they were, before the pandemic. I can assure you that's not a positive outcome. That would be deflation. The last time America had extended periods of deflation was the Great Depression, and Japan's been grappling with deflation for actually about 2 decades already. And the reason for that is if prices are going down in the economy, so where you think electronics, then groceries, clothing, whatever it could be, vehicles, that means the average person will start holding back on their spending. And that means demand decreases. When that happens, corporate profits decrease. They then have to, in order to maintain their profits, they start doing mass layoffs, unemployment rises, income decreases. So you can see this is a vicious cycle in an environment where prices go down. So we certainly want to see the rate of change slowing, but we don't want to actually see price going back to previous levels. So I mentioned corporate profits. So this is one of the real good tailwinds for stocks in general. This is showing the relationship between the price of the S&P 500 versus the actual expected profits or earnings per share for the S&P. The shaded area is the estimate. This is Wall Street's estimate, so the average consensus for analysts. And you'll notice that that orange line is much higher than the blue line. So that's implying that if this long-term trend is in play, that if profits are going to be at record levels, we should not be surprised to see the S&P 500 at record levels. Already during 2024, we've had 38 record closes for the S&P, and this is off the back of those profits. Looking a little closer at these numbers, this is looking at the projection for 2024 as well as so the end of this year as well as the end of next year. 2023 was actually a record level of 213, you can see on screen. So the average expectation is a 13% growth this year, and then next year another 15% growth. So profits are extremely robust, and this has got a lot to do with how stocks have maintained these all-time high levels. Not every company is doing well, so you still need an active manager to do the due diligence on your portfolio, do the analysis to make sure the stocks you're invested in are in accordance with the goals and the objectives you want to achieve. But this is just overall showing that for the S&P 500. So that's it on the economy. I then want to switch to a big focus is that of monetary policy. We spend a lot of time analyzing the Federal Reserve, what Chair Powell and his committee are doing. Next week, Wednesday, is the next meeting that the Federal Reserve will have. The expectation is, as of today, is no change to interest rates. The futures market is implying a 7% chance of a rate cut, so that is a very low probability. So most people are expecting it to be on hold. Then they go to Jackson Hole for their annual economic symposium from August 22nd to 24th. It's the longest central bank conference of its kind in the world. It's been going around since 1978, and normally the Federal Reserve come out of that and they give a view of how they expect to manage interest rates and monetary policy going forward. The meeting after that will be September 18th. The market, as it stands today, is pricing a 90% chance of a rate cut on September 18th. As we all know, that is pretty close to the election. So in order for them to not be criticized for being influencing the election, they will need to see very strong data. And as I mentioned, unemployment as well as inflation cooling as well. So the big conversation for capital markets is talking about when and how many interest rate cuts there are going to be from this point forward. This is an example of some of the research we get in the industry. This is from Ned Davis. They're a phenomenal independent research house. And what they analyzed is, if you look at point 0 on this chart, is when the Fed have cut interest rates, what has the performance been for the stock market after that time? So you'll see in the gray line on your screen, that is when the Federal Reserve are on what we call a slow cut cycle. So slow is defined as 5 or less interest rate cuts over the next 12 months, and a fast cycle is more than 5 over the next 12 months. So speed matters. It's not that it's not as positive an environment where they do a fast cutting cycle. It's just not as conducive to growth as what we for slow. So if you think about a car analogy, go back to 2022 when inflation was hitting 9%, the Fed panicked. They raised rates the most aggressive since the 80s, so aggressively hitting the brakes on the economic growth. Now we're at the top of the cycle. They're actually looking towards tapping the gas pedal. And sticking with that analogy, it would be far more preferable capital markets if they just gently hit the gas pedal rather than pedal to the metal, because that would typically imply if it was going to be very fast rate cuts, there's potentially a strong risk of a severe recession. Hence, they're trying to inject a lot of growth back into the market. So you might see the media talk about Goldilocks. That's what we're trying to achieve here. The economy not too hot nor too cold, and this amazing equilibrium somewhere in the middle. So where we look today, the balance of probability is we're most likely going to be in a slow cycle. The market's expecting 4 interest rate cuts in the next 12 months of 0.25% each, which would fit that bill. So that's it on monetary policy. As you know, it's a lot of detail. We certainly second half of this year, it's going to be a big focus. Next, I want to talk about valuations, just generally on stocks. We believe it's in the fair value of the range. Looking at some of the sectors, some of you may know the Magnificent Seven. What I'm showing the red line here is the Elite Eight. So it's those 8 large stocks. And this is the price to earnings. So anything in life, whether it's an asset or a business you buy or invest in, it's the price you pay for that earning stream. No surprise, these Elite Eight have had tremendous growth in terms of their revenue as well as their profits. They've commanded a premium versus the general stock market, which is the blue line is the S&P. And then if you actually exclude those 8 stocks from the list, you look at the other 492 names in the S&P, that is the green line. So you can see much lower valuations and multiples for those sort of stocks. So there is this divergence, and hence anyone's portfolio that's at Clark, we do value the word that Dean used, certainly diversification is important, and as well as the opportunity. This is showing the same data, but looking at different sectors. So the actual price to earnings. You got value, core, and growth. So core would be somewhere in the middle, a blend between value and growth. And you've got large, mid, and small cap stocks. So if we look at large cap value, that would be your typical dividend paying stocks. Those are trading at 16 versus large cap growth is 27. So that's a 40% discount of large cap value to large cap growth. So ones who are invested in those type of dividend paying stocks, they are trading at much lower valuations than it is of some of the growth names. Switching to the fourth gauge, this is investor sentiment. It is the most sensitive. It's actually a contrarian indicator for us. So we believe in the philosophy of Warren Buffett's his famous quote back in 2008 is be fearful when people are greedy and be greedy when people are fearful. So one of the data points we look at is the American Association of Individual Investors. This is a weekly survey, and it's a simple question that is asked is, where do you feel the stock market will be in the next 6 months? Are you optimistic? That would be bullish. That's the green. Are you bearish? Pessimistic? That would be red. And then neutral will be clearly somewhere in the middle. So as the market has gone up, I just want to highlight on screen, that sort of area is actually look at sort of the latter part, sort of October timeframe onwards. If we actually look at the performance of the S&P over that time, you can see how individuals have actually got more and more optimistic over that time frame. Last week, Thursday, they got to their max bullish reading. It was 49.2. That was close to the 1-year high. So as I mentioned earlier, we view this as contrarian. So that is normally indicative of a short-term pullback. That's what we've certainly had this week. And no surprise this morning, the new data came out and they're back to more normal levels and not excessively optimistic in terms of their expectations for the stock market. Then looking at it from an institutional lens, some of you may be aware of the so-called fear gauge. This is the VIX or VIX index. This is on the red line on your screen. Going back to 2020, it spiked to levels above 80. The last time we were at 80 was going back to 2008 when Lehman's collapsed. So you can see how volatility as measured by the VIX has actually been pretty low during 2024. So we have been saying that investors have been complacent. The PE basically was below 13 for quite a bit of time during this year. Yesterday, it went to 18. The long-term average is actually a level of 20. So even with recent volatility, it's still below the long-term average. Thinking of volatility another way is thinking of the S&P when it falls 2% or more. We actually just broke a record yesterday. It was the longest record in 17 years where the S&P 500 has not had a 2% pullback. We've had 356 trading days or business days where the S&P did not have that, and this was a Bloomberg report that came out this morning. And then another one is the S&P has been positive for 28 out of the last 38 weeks. So that's not something we've seen since 1989. So as most of us would know, being invested in capital markets, we should expect some turbulence. And this is what we were saying is we've had a tremendous run since those October lows, that it is a healthy dynamic to have some volatility back in the stock market. So then the final gauge is interest rates. I mentioned how the Federal Reserve are most likely on the path to reducing interest rates from this point forward. I thought it'd be useful to look at the difference in the past 4 years. So this is the yield curve. The red line is where we were July of 2020, and then the blue line was the beginning of this month. So the yield curve shows each yield you'll get from 1 month all the way up until 30 years maturity. So going back to 2020, clearly in an environment where interest rates were close to zero, that's where those yields were at that point in time. What you might notice is that the red line is upward sloping. So that's what we call a normal yield curve. And then the blue line is downward sloping or inverted. So we've been inverted in the yield curve for over 2 years. It's something the market focuses on. Every time it's gone inverted, it's predicted a recession. It's been very reliable for over 50 years. This time it's been inverted. The previous record was set in 1978. It was 624 days. It was inverted. We are now, as we stand today, 740 days plus in terms of this inversion. So it is a record that hasn't been seen in over 50 years. The reason why it typically has predicted recessions is this is basically incentivizing the finance and capitalism in general to save or invest short term rather than long term. So think money market yields, think cash equivalents. You're getting a higher yield for say 1 month to 6 months than you are getting 10, 20, or 30 years. So generally it's a drag. That's what slows down the economy, is because it's incentivization for the short term, and you're not really encouraging risk taking on the long end of the fixed income. So that's just one of the things we look at. In Wall Street, there is comments made that if you are 2 years too early or predicting a recession, it's called being wrong. It's like the weatherman trying to predict the next, hurricane. At some point we know it will come, but if you're that early, it's not really that helpful. So thank you to everyone for listening thus far. We wanted to keep the election right till the end. Clearly, this is the biggest question we continue to get. We have a great saying, Glenn Dorsey, who heads up our client portfolio management team. He says that markets don't see red or blue, they see green. It's the profits that companies generate, the companies that you're invested in. That's where we spend a lot of time focusing on. If you don't believe me, think of just this month alone. Look at what happened politically, the most uncertainty we've seen in some time, an attempted assassination. We had the incumbent not seeking re-election. This is unprecedented. So you would think these things would cause some short-term turbulence for stocks, but really the market has shrugged it off, and it really took some earnings, which came out on Tuesday, was Tesla and Google, or Alphabet in particular, which led to some of that drawdown. So it's an earnings focus, not necessarily a political focus. So I wanted to share some of the insights that we have. So this is looking at the performance of the S&P 500 since 1950 up until the end of 2023. So what you will notice is that a divided Congress, so when one party controls the House and the other controls the Senate, that seems to be a good environment for stocks to do pretty well if we look at the S&P. just want to draw that there are some anomalies. If you look at that 1% return under a Republican president and a Democrat Congress, the anomalies there are, you think about George W. Bush, the dot-com crisis in 2008, that led to some of that negative return. So it's got very little to do with economic, political, policies at the time. It was coming out of dot-com crash, and it was certainly Lehman's collapse in 2008, which led to, some of those lower numbers. One thing that is really important to remember when we look at this is, had you invested $10,000 back at the beginning of 1950 in the S&P 500, it would be worth over 3.2 million today. So that includes dividends reinvested and the power of compounding. So it equals about an 8% return per annum over that entire period. So, regardless what happens in politics, we certainly do say stick to your investment strategy that Dean and his team have designed for you. So linked with that, we also wanted to look at the different election years based on if the incumbent wins or loses. So where we stand today is either the blue or green line. This is looking at the equal weight of the stock market. So that's basically make every share, say in the S&P 500, and giving it an equal position. It's to show a broad-based participation in stocks. No one's portfolio in reality is going to be equal, but it's just to give an idea of what the average stock would do over that time frame. So in final, I just want to mention some of the thoughts. So I mentioned how the economy is slowing. What that really does is with unemployment going up as well as inflation cooling, it's raised that probability of the Fed actually reducing interest rates, and it's increased that probability of the interest rate cut coming that much sooner. Earnings growth is very strong. We continue to see record profits. Interest rates are elevated. So if you think about your fixed income in your portfolio, now is certainly a good time to think about locking in those bonds from the yields that are on offer. We certainly do believe the probability of a hard landing for the economy has decreased. Therefore, a no landing or soft landing has actually increased over that time. But there's still time to go until the election. There could be volatility that I already mentioned that could markets think of geopolitical risk, any sort of global events as well, but that should not disrupt the overall earnings growth that is the underpin of stocks as we stand today. So with that, I wanted to keep it to just over 30 minutes. Do want to welcome questions. We highly appreciate your attendance, and for the clients that haven't trusted us the opportunity to manage your wealth, we're very grateful. As Dean and Mark mentioned, we are very committed to providing regular investment insights on capital markets. So I do want to open that opportunity now.
Wonderful. Ryan, thank you so much. Some excellent information this evening. As Ryan mentioned, this is a Q&A session. If you are not comfortable unmuting yourself and asking in front of everyone, please feel free to utilize the chat feature. And chances are, if you have a question, someone else has the same question. So please don't be shy. Feel free to ask away. We have the professional in the room, and we would love to expand more on anything that is near and dear to you. And if no one does have questions, I have a few. So. Well, I will break the ice. One thing, Ryan, and this has been for a very long time now. When we look at PE ratios being so high, one of the things that dates all the way back to when I first got into this business, we wanted to look at stocks that had a discounted, stocks that you could buy at a discount. And what I've noticed over a decade now is that if you're looking for a discounted stock, you're missing out on a lot of earnings and a lot of growth potential. Is there any end in sight to where we will see PE ratios start to trend back to, we'll say, a more normalized rate? I mean, at this point, it's just, you show the 30s, the 30 plus with all of the mega cap 8. When will we start to see, in quotations, normal PE ratios again? And I
Yeah,
don't think that it's a very loaded question. I realize that it's just something that for the last, decade, I've seen this continue to trend in this direction. And it's incredible to me. So if you can expand on that just a little bit, that'd be wonderful.
yeah, the P/E ratios is one of the variables to analyze, as you mentioned, Dean. If you look at the trend over time, a lot of those growth stocks have commanded higher PE ratios, higher multiples versus the general stock market. So it's in the environment that don't pay their dividend, to your point, you are reliant on capital growth from those stocks to generate that return. Uh, most individuals who are retired, they do require dividends in their portfolio. So hence, growth would be a smaller allocation because a lot of growth companies do not actually even pay a dividend. So you're really relying on management to you think about some of these companies, they can spend billions on cash flow for projects or businesses that may not actually generate any revenue. So they are really trying to chase that growth. So that's why a good balance of the stocks that do pay dividends, they're normally more mature in their business profile. So that means they have some of the characteristics we look for would be anti-fragility. So they're a little more insulated during the economic cycle. And then for us and also our clients as shareholders, when you receive that dividend, it gives you, a good appreciation of the way management are navigating the cycle. So whether it's supply chain issues, high inflation, a tight labor market, international issues, it's always great to get that dividend at the end of the day because that's actually something tangible. So when it comes from valuations, to your point of this dispersion we've seen, uh, just looking at a stock based on PE, you may never have owned some of those high flying growth names if you waited for an opportune time when its valuation was low. So what I'm referring to there is sometimes stocks are cheap for a reason. So we call those value traps. We want to avoid that as much as we can. And the way we do that is we look for companies with earnings momentum. So when there's declining earnings momentum, so i.e. your profits are going down, your sales are reducing, that's normally indicative that there's something happening in your business, which is why you're not seeing growth. So even though it might be cheap from a PE, you've got to look at these other factors. In a perfect world, you'd want growth at a low price. There's another acronym called growth at a reasonable price, GARP, which is somewhere in the middle. That's what you'd want generally over time, but it's very, very challenging to get that because good high quality growth stocks do command that premium. We've seen that for some time. The US has had a premium versus international stocks for 20 years, and rightfully so. It's outperformed. Could AI be the next catalyst to continue that trend for those growth names to maintain that premium? That certainly could be the case. But yeah, it is interesting to see the trends over time. But you don't want to underplay the power of dividends and what that does to your total return over time. It's very slow, it's very measured, but that's what really adds to a lot of return over time is the dividends.
Right. I think that's great insight too, because a lot of our clients in a diversified portfolio for a number of years might lag the S&P. And it's not necessarily because the underlying stocks are not performing well. It's just a matter of the diversification piece that we mentioned earlier and how important it is to not be super exposed to just those growth oriented stocks that have such high price PE ratios, and having a good um, amount of dividend payers on the books to create some stability in the portfolio, because eventually at some point market cycles might change and they might go down. The one other follow-up question that I had was the inverted yield curve that has continued for a very, very long time here. When do we start to see that change? Is that going to be maybe when some of these 10-year bonds that were at a very low coupon rate start to mature? Are we predicting that maybe within the next 3 to 5 years, once those treasuries that come off the books, maybe that at that point in time we'll start to see the yield curve kind of transition back to what would be a normalized yield curve? Is that what we're seeing from your standpoint?
So we're already starting to see the gap narrow. So a classic one to look at is the difference between the 10-year Treasury and the 2-year Treasury. So at its peak, it was close to 2% differential. As of today, it's somewhere between 0.2 to 0.3%. So it's narrowed pretty meaningfully. The reason why the 2-year started lowering is what I was mentioning with the anticipation of the Fed to actually reduce interest rates. Whereas the 10-year is a little more insulated. It's not that sensitive to what the Fed's doing. It's the more shorter dated stuff that's affecting that. So what you want to see is the 2-year reduce more and the 10-year to actually start increasing. So that will help normalize it. So we're already seeing that trend. Still got some way to go, but it's at least showing that encouraging path and not widening. Widening would be, a far worse circumstance to be in. So at least it is actually shortening. So it means we're closer towards the end than actually being further away than what we were 2 years ago.
Sure. I think a lot of our more conservative investors can certainly appreciate the inverted yield curve as it stands right now. And when we can look at getting, over 4.5% in just a money market, that provides a lot of peace of mind. But at some point in time, we know that's going to go away. And, at what point in time do we, start to inflect some of that back into, the capital markets and take advantage of certain buying opportunities. So I appreciate the insight on that as well. I believe that we have one question that just came through here. So let me jump into the chat here. I'm going to read this out loud to the audience here this evening. What is the view on how long this recent pullback on the Elite 8 valuations will last? The hype around AI doesn't appear to be any lower yet. The pullback is being blamed on a reconsideration of AI's profit impact. So I guess if I were to summarize that, I guess it's being blamed on AI's profit impact. When I'm trying to rephrase this, Ryan, if you run with that would be great. What is your view on how long this recent pullback on the Elite 8 valuation will last? The hype around AI doesn't appear to be any lower. Yet the pullback is being blamed on reconsideration of AI's profit impact. Sorry, I missed a punctuation there. Sorry.
So don't have as much of a view specifically on the Elite 8. We'll just use yesterday as an example. So the Elite 8 were down 5.9% at the close. The S&P was just over 2%. So what is actually happening is this rotation. So the market and people are taking profits from those names and actually moving into the broader market. So the more unloved, I mentioned those dividend stocks, the large cap value, that's where we've seen it. I mentioned the mid and small. So that rotation is pretty healthy. So the S&P 500, I mentioned our price target for year end is 5,800. So we have 5,400. If you think of the Elite 8 are part of the S&P, it is a big constituent in the index. That's how it gets. So this is more of a short-term pullback for us. It is good, have some of that turbulence back in the market, but we certainly are very confident of the earnings growth and on constructive equities, which is why we raised our price target from 5,300 towards that 5,800 level.
Thank you, Ryan. Please don't be shy. If there's any further questions, please feel free to take advantage of this time here this evening.
Hey, Dean, Chuck Reed. How are you?
Chuck, how are you?
Good. That was my question on the Elite 8. I have another question on international. So for the last couple of years, we've been told as investors that our portfolio should be quite limited on international equities. And I see the profit reports out of Europe, and I get why. Do you see that changing, Ryan, anytime soon, or do you think Europe will continue to be a don't go there for a while scenario?
So viewing internationals, the way we view it is, if you look at the portfolio construction, the actual stocks, we have a quality bias in the portfolio. So we want to own the best stocks regardless of where they're listed. So whether they're listed on New York Stock Exchange, or you mentioned European, whether it's Paris or Frankfurt, we just want to make sure we have those best quality stocks in the portfolio. In terms of valuations, I mentioned the S&P is at roughly 1920 as a valuation. International stocks are, somewhere between 12 to 13. So they are much lower, but this is what I was talking about. Sometimes things are cheap for a reason. So there's not much optimism priced into those stocks. But if you were at a starting point, you certainly would want to allocate, when the valuations are lower. The best way I can think of, valuations is think of a rubber band or an elastic band. The more you stretch it away from its long-term average, at some point it's going to snap back. So we don't know when that timing will be for international. What are some of the catalysts or tailwinds? Slight dollar weakness, that's normally good for international. That's a good tailwind to have. If you think what Europe specifically does very well, think healthcare, pharmaceuticals. They don't do technology that well. Think luxury goods, really, really strong luxury good companies in Europe, and then financials as well. So with our quality focus, we more Western Europe, so it's Germany, France, Switzerland, Sweden, UK, and then in Asia, it's more Japan. And most of the stocks are actually household names most of you would recognize on the call. I mentioned that because a large proportion of those international stocks' revenue is actually generated in the United States. So their growth drivers are actually based on the growth of the US economy. I'm sure some of you have seen the craze with GLP-1s. There's obviously one in the US, which is getting a lot of attention. There's one in Denmark. It's listed on the Copenhagen Exchange. That's now Europe's largest stock. Is actually overtook LVMH, which was Louis Vuitton, Moet Hennessy. So this is now the biggest stock, and that's off. They have Ozempic and Wegovy. So there's a lot of these other growth stories that you want to allocate to. So that's where international really comes forward. But Chuck, to your question, you still want to have obviously your conversation with Dean. You still want the bias of your portfolio being domestic stocks. And then the sort of good thinking for international, everyone's circumstances are different, but you're looking between, say, 25 to 35% of your equities to be international. The benchmark's about 40, so I'm not saying get anywhere near that. That's a very high level. And then a final point on international is even the S&P 500, 41% of its revenue is generated outside of America. These are multinational conglomerates. They are generating substantial revenue from abroad. So even with large cap companies that are listed in the US, still generate profits from abroad. So there's multiple angles to get international within the overall strategy.
Thanks, Ryan. That's very good perspective. Appreciate that.
Hey, Dean, this is Dave Kelble. I got a question. We're talking about the large cap versus small cap, and it seemed to be that there was the trend was going more for, down towards the small cap. Do you, Ryan, if you can talk a little bit about this, do you see this as being just because of the rotation out of the Elite Eight, or do you see it as a general trend larger than that?
We do see it as a good trend. Just to mention why small caps do well in this environment. Smaller companies, they don't have the moat balance sheet or the huge, conglomerate financial statements. So they generally borrow more short term is the first factor, and they clearly pay higher rates. So if you think of, a smaller business, they just don't have the luxury of borrowing at lower rates than what a large organization would have. Larger companies, no surprise, think CFOs, just like many individuals in America, remortgaged, at the very low rates, 3 years ago. So did corporate America. They also lowered their rates. They borrowed at those low levels. Smaller companies, because it's short term, those are obviously coming up for maturity. So hence, they're going to have a much larger interest expense on their income statement. So that's why they call them interest rate sensitive stocks. They are more sensitive to what's happening with rates. So with the environment of the Fed cutting down, there is more tailwinds in our view for small caps. Some of this, there's multiple strategies to get that allocation. Again, it depends on one's risk tolerance. And what we've also noticed, some of the catalysts within mid and small caps are not even small, even some of the mids, is outside of the AI boom, everyone's focused on the chip manufacturers. They're focused on the software, which is obviously a good place to go. But the second derivative is also a good way. So there's a huge database warehouses being built, so that huge infrastructure to actually house these this AI technology. just think of all the, just think of the electrical equipment, think the HVACs, think actual construction of this data. So a lot of the positions we have in one of our larger overweights is actually industrials, which is, one of the catalysts and themes is this AI. So there's companies that are building this infrastructure that are doing well. And then the second one is even utilities. You think about, electricity. There's so much demand for these data centers. That's also another growth. So something as boring and vanilla as utilities, even has a good potential for growth as well. So there's multiple angles from this. One could obviously argue a lot of that is priced in, but that's why we need to do that additional homework to see what that potential is from this point forward.
And to further that point, Ryan, I've read that just the sheer practical application of AI within the small business sector is going to cut cost for them. It's going to enable them to reduce headcount potentially, which in fact will go right to their bottom line. Now, this is a longer term play as the practical application does get put into place. But I do concur and agree with Ryan and a number of other analysts that say that, Dave, this is not just a sheer rotation. This is actual momentum now transitioning back to an industry that has underperformed for over a decade now. So,
Thank you, guys.
well, we are coming up on the hour here. If we do not have any further questions, I just want to thank Clark Capital, Ryan, Mark, Joe, and team for joining us this evening, taking time away from your families to provide us with some great insight here. I can't thank you all enough for the partnership. I want to thank each and every one of you for joining us on the call, each and every client, each and every staff member here. This is a great evening, and I appreciate everyone being a part of it. So thank you again for joining us. Have a pleasant evening.
Thank you, everyone.
Thank you.
Thanks, Dean. Thanks, folks.
Thanks so much.